All right, let's talk about a company that's really shaking up how people live in Singapore. It's called the Assembly Place, or just TAP for short. They're the biggest co-living operator in the country, and they're about to go public with an IPO. That means it's the perfect time for us to dig in and see what's really under the hood.
So here's our game plan. First, we'll get to know the company. Then, we'll dive into the bull case, all the reasons to be optimistic. After that, we got to look at the bear case, right? The key risks. Then we'll follow the money and look at the financials, and we'll wrap it all up with a neat little investor's checklist. Let's do it.
Okay, first things first. Who exactly is the Assembly Place?
So what does TAP actually do? Well, picture this. Stylish, fully furnished homes where you've got your own private room, but you share all the cool common spaces like kitchens, lounges, sometimes even pools or gyms. This whole vibe is built around an idea they call community living.
And what is community living, you ask? It's basically a modern twist on housing. You get your own space, but you share the bigger areas. And the whole point is to actually build a community, to connect with people, which can be super tough in a big city. It's not just about renting a room. It's about finding your tribe, so to speak. Now, this is where their business model gets really interesting. They are not a one-trick pony. Nope. They've got 6 different brands targeting basically everyone, from students to working professionals and even seniors. And here's the kicker. They use an asset-light model. All that means is they lease properties instead of buying them. This is a huge deal because it lets them expand super fast without needing mountains of cash. And it looks like it's working. They were just ranked one of Singapore's fastest growing companies. All right, so that's the setup. Now let's get into the good stuff, the bull case. Why might you get excited about this company as an investment?
First off, and this is a big one, market dominance. We're talking a whopping 34% of the co-living market in Singapore. That is huge. And it's not just a cool number to brag about. That kind of scale gives them massive leverage when they're negotiating with landlords and suppliers, which, you guessed it, can lead to better profits. And to give you a sense of what that market share looks like in real life, they're currently managing over 3,400 keys. Now, a key is just industry jargon for a room you can rent out. So 3,400 rooms spread across 100 different properties, yeah, that's a pretty big operation. But here's the thing, they are not even close to done. Their goal? 10,000 keys by 2030. That's almost tripling their current size. Talk about an ambitious growth plan. So let's just recap the bull case, shall we? You've got clear market leadership, check. A diverse portfolio, so they're not putting all their eggs in one basket, check. That super scalable asset-light model we talked about, check. Big plans to expand into other countries like Malaysia, check. And to top it all off, an experienced leadership team that knows what they're doing. That's a pretty compelling list.
Okay, that all sounds great. But a smart investor always flips the coin over. So let's talk about the other side, the bear case. What are the potential headwinds here? What could go wrong?
And what's really interesting is you don't even have to dig that far to find the risks. The company lays them out pretty clearly in its own offer document. So what are they worried about themselves? Well, first, you've got the usual suspects. This industry is super competitive. Their demand is tied to the wider economy. Things like immigration and student numbers really matter. And since they lease, they're kind of at the mercy of landlords renewing those leases. Plus, their tenants are often on short contracts, which makes it harder to predict revenue way out in the future. Standard stuff, but still important to remember. But then there's this one specific thing in the document that really makes you go, get this. About 1/3 of their properties are on long-term leases that are legally supposed to be registered. But the company states they haven't actually registered any of them. Why does that matter? Well, in simple terms, if a landlord sells one of those buildings, the new owner is not legally required to honor TAP's lease. They could be forced to renegotiate or even get kicked out. That is a huge operational risk, and it's directly tied to that asset-light model. All right, we've heard the arguments for and against. Now, let's do what really matters. Let's follow the money. How has the company actually been doing financially? Because the numbers tell a fascinating story. Okay, so looking at their numbers, a couple of things jump out immediately. Look at that revenue line. It's just exploding upwards. It's nearly tripled in just 2 years. Gross profit, same story, looks really strong. But then you get down to net profit, and it's all over the place. A small profit, then a loss, then a really big profit. So what on earth is going on there?
The answer is accounting. A huge part of that profit calculation is from something called changes in fair value of investment properties. Basically, it's a non-cash adjustment that reflects the changing paper value of their leases. It's kind of like when your home's value goes up on Zillow. You feel richer, sure, but you don't actually have more cash in your bank account. This number can swing wildly, and it's been the main reason their bottom line looks like a roller coaster. The key takeaway, their actual business is growing like crazy, but the reported profit has been way less stable.
Okay, we have covered a lot, so let's bring it all together into a final checklist, putting the bull and the bear arguments right next to each other to summarize this whole investment case.
So here it is, side by side. On the bull side, you've got a dominant market leader with a huge ambitious growth plan, all built on a scalable asset-light model that's spread across different sectors. And on the bear side, you're looking at a super competitive industry, a real reliance on landlords, that volatile net profitability we just talked about, and that very specific, pretty significant risk with those unregistered leases. The question for any investor is, which one of these columns carries more weight for the future? This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.